We're next going to dig a little bit more into life insurance and annuities. Those are the primary insurance products that you would be concerned with typically as a financial advisor. This particular segment is going to mainly focus on life insurance. The next one will focus mainly on annuities, but you want to kind of put them in context. So you see I've already noted a few things. Annuities and life insurance are economically the opposites of each other, pretty much in every sense you can think of. Remember, life insurance protects against premature death. It would pay a lump sum amount to the beneficiaries at the death of the insured. We would use it to meet needs of those beneficiaries that would have been met if the insured individual had not died prematurely. So think about it. Paying premiums on an annual basis. We don't know when the payout will occur, but the receipt of the lump sum will occur at death. It'll be received by the beneficiaries. In contrast with the annuitant, the annuitant buys the policy at the start with a large premium payment. Then, until death, they receive back small amounts of money. They can't outlive it, because the insurance company will pay. Some annuitants will die early and they won't get very much back. Others will live a long time and get more. So it's insuring against longevity risk. No one individual can be sure how long they will be alive. These are both risk-sharing mechanisms. So that's an important thing to get in context. Make sure you look at insurance and annuities as fundamentally what there are. However, taking that basic, you can spin all kinds of variations. You can add additional features to the life insurance or to the annuity. More complexity, more benefits, more features. But of course, you're going to pay for those. So don't assume that by adding additional features, you're necessarily getting a better deal. You're going to pay more for any feature you're adding to the product. With that, let's dig into life insurance in this segment, and in the next, we'll look at annuities in more detail. There are kinds of insurance. The most basic is called temporary or term. It's a form of pure insurance. You make a periodic payment. If you make a payment this period, you're insured for this period of time. Next period? Oh, we'll rediscuss. Do you want a new policy at a new premium? So the premiums are likely to go up every time you extend it because you're getting older and the chances of you dying sooner are going up as you're getting older. So pure insurance is pay a premium, you're insured for this period. We'll talk about what to do in the next period. That's going to be the lowest cost form of insurance. The opposite is what's called permanent, or sometimes called whole life. You make payments, but the payments are by contract a level amount. They don't go up. As long as you continue to make them, you will have been insured. You don't have to renegotiate each time. The premium will start out higher, but it will be fixed. Versus with temporary, the premium would start very low, it'd be going up, and of course maybe something would happen where the insurance company doesn't want to insure you. They could just cut it off. With whole life, you continue to pay, you remain insured. Now there's a variation that developed on whole life called universal. It has many relationships to whole life, but it's again, you make a payment, as long as you make it, you're insured, it's continuing insurance, but they add a lot of bells and whistles. They might add features like, well, you can skip a couple payments and we'll make some adjustments if you do. Or you could increase the payment and increase the amount of insurance if you want to. Or you could tie the money in some way to the rate of return on an index, like a stock market index. And that would affect how much insurance or how much you have to pay in the future. You're adding a lot more features. You may be incorporating some investment-like features. It can appear beneficial, but remember, the company is going to think about this. They're going to price the product appropriately for all of the features. So temporary insurance is easy to understand and analyze. Traditional whole life is pretty easy. Universal life sounds good, it can be, but the complexity also makes it harder to understand what the ultimate true costs are for what you're going to receive. How does the insurance company look at this? If you understand that, you have a better appreciation of what you're paying for. It's a big time value of money problem to the insurance company. They have all these premiums coming in, they invest it, they can estimate in aggregate what they're going to pay out, they can estimate the rate of return they're going to earn, and then they can back into how much they should have charged for the product on the front end. That's what they're going through. That's what actuaries do. So they're thinking about insuring not one person, but a group. They're charging an aggregate set of premiums sufficient to make the aggregate promised payouts. So they can, in aggregate, do a pretty good estimate of death rates. We may not be able to predict when one person would die, but we can probably predict in aggregate the number of people in a given year that would die. By the way, these things usually include things like exceptions for war, other kinds of situations where death rates might skyrocket. Oh, there was fine print. They don't have to pay out in that case. So they're very good at turning this into a time value of money problem that can be analyzed. Then they can determine how much to charge on the front end. They can estimate what their expenses will be. They can estimate what the rate of return they're going to earn on the money is while they're holding it. That's how they determine what they will charge. They can build in a profit margin. These are for-profit companies, which once again is why you don't want to think of buying insurance as a way to build wealth. It probably isn't in aggregate. It's an insurance against risk. Institute doesn't talk about it. There are such things as not-for-profit insurance companies, but they also have to have a margin because they have to build up a reserve to be able to make sure they can make what they pay out what they promise to pay out. It's the equivalent of having a profit margin, so you really can't escape that. The insurance company is promising to pay. They're going to have to build up a reserve or capital to meet those obligations. Things they've got to go through, the mortality estimates. We've looked at mortality tables, given the age, what is the probability of life or death? It can be tied to starting age, it can be tied to sex, male or female, it can be tied to lifestyle issues that might affect when you would die. That will be taken into account. They can calculate what they call the net premium, based on the projected rate of return earned on the premiums and when we would make the payouts, what needs to be charged. But then they have to add to that a load that would cover their expenses and their profit, and that would determine the gross premium they charge. To you, the purchaser, it's just gross premium. This is what you got to pay us. That's what you must pay. But underlying it is the net versus the load. So they're not charging you just to be able to make the benefit payment. They're also charging to cover their expenses and profit, which is again a reason not to think about this in aggregate as a way to build wealth. It's a way to ensure risk. Taking an example of this, for a $1 million life insurance policy, what would cause you to pay more? You're male instead of female. Males die at younger ages than females in aggregate. You're older. You're going to die sooner. The payout will occur sooner. They won't invest the money as long. They got to charge more now. You have very risky habits, bad health. You're a skydiver who smokes 5 packs of cigarettes a day and drinks excessively. You don't probably have a very long life expectancy. They would have to charge a lot if they would even sell you insurance. If they really think you're too risky, they can just refuse to sell you insurance. You might build in other benefits. If I die by an accident, my beneficiaries get more money. Or if I lose a leg, I get a payout for that. They will take that into account and charge more. Or maybe they promise that there will be what's called a cash value buildup. At some point in the future, if you want to, you could redeem some of this money early or borrow against it at a bargain rate. That's called building cash value. Well, they got to charge you more for that. Or maybe they say under some conditions they'll rebate some of your premium and they'll call it a dividend. Well, then they're going to charge more on the front end in order to build the money up to be able to rebate you a dividend in the future. Don't assume there's ever a free ride or never a free lunch in these situations. So I like this schematic. Let's think about the simplest annual term life insurance, the lowest premium for the amount of insurance. Let's go to the other extreme. Universal life, lots of bells and whistles, a promised buildup of cash value that you could access early. They're going to charge more. So we're just showing you as you move and add features, assume what you're paying for $1 of insurance is going to be going up, because it will. The insurance companies are not dumb. They know how to do the math. That creates an interesting dilemma. So if you're looking for insurance and you go get a bunch of policy quotes, odds are, if it's anything other than simple term insurance, there's bells and whistles, and it's hard to compare the policy of Company A with the policy of Company B. And Company C might offer you 3 different policies with different prices and different features. How do you make a comparison? It's not easy. Make assumptions, make projections, and come up with a comparison. Because it's so difficult, in many countries, regulators require certain kinds of calculations be provided. The regulator is not saying this is the right number. It's just an arbitrary calculation based on a defined set of assumptions, so you could make a comparison. Now, the different methods may not all come out in which is the best policy. They may differ. So it's not telling you the final answer, but it is giving you information to begin to compare. This happens to be 2 approaches that are used in the U.S. in some states, what's called the net payment cost index and the net surrender index. One of these is making the assumption that on a certain date death occurs and the face value of the insurance is paid. The other is assuming that after a set period, the policy terminates. There's never a payoff, and any cash value that's built up is then paid off. Not the face amount, no death, but any cash value is captured. So what do you think is more realistic? You decide that, then a set of calculations can be made. So let's take a look at these. As an example, let's take the purchase of an insurance policy for $500,000. $500,000 will be paid at death. We're going to make the assumption that we're analyzing over the next 20 years. There's an annual payment made, premium payment, cost of the insurance of $9,000. It does include a buildup of cash value, which would be $110,000 20 years from now. We're making a discount rate assumption to discount things to present value or compound to future value. And we also have a dividend, which really means the company is charging you more as a premium, but then they rebate some of that to you at the end of each year. The general assumption and the general mechanism is you pay the premium at the start of the year. If there's a rebate dividend, that comes at the end of the year. So we will have to take that into account in the computations. The methodology here is to project first everything to future value. So we have an annuity. We're paying in $9,000 at the start of the period. That is called an annuity due. You can replicate these, but when you pick up your calculator, you must first set it up as a payment at start of period mode. Most calculators are set on end mode. You've got to put it in begin mode. Punch in the payment. 4% is the discounting rate. In this case, we're projecting the future at 4%. 20 payments. Those payments have a future value of $278,723. Now, there's also a rebate coming back of $2,000. It's called a dividend. But the dividend occurs at the end of each year, so you've got to reset your calculator into ordinary annuity or end mode. 2,000, 4%, 20 periods, future value $59,556. Those are the underlying numbers that have to be computed, assumptions that have to be made before we can calculate the index numbers. Now, for the payment cost index, we are assuming that at the end of 20 years there is death and there is the payoff on the insurance. Well, then on an annualized basis, what did the insurance cost? That's what the NPCI is coming up with. So we're going to take the future value of the premiums less the future value, the dividends received back. In future value, the insurance has cost us $219,167. Then we're going to take that number, I'm going to drop down for a minute, we're going to annuitize that future value. In future value, the insurance is costing us some $219,000. Let's turn that into the equivalent of, on a net basis, what did we pay each year for the insurance? So we've got the future value. We still use the 4 now as a discount rate. It's 20 periods in the future. As a payment, this is as if we had paid $7,077 a year at the start of the period. It's not just, let me point this out, it's not just the $9,000 minus the $2,000. Why isn't it just that? Because this is paid at the start of the period, and this is received back at the end of each period. If I don't receive the $2,000 back until the end of the year, it's not worth quite as much, and that's why the annuitized cost a year is a little bit more than this differential of $7,000. Hey, I know, this is time value money. It gets really picky, but this is how you do it. Now, we bought how much insurance? $500,000. So that's 500 of thousands. That's 7,077. So per $1,000 of insurance, it's as if we were paying $14.15 a year for the insurance, per $1,000 of insurance. If we had multiple insurance policies and comparing them, I'd prefer a lower number than a higher number to what I'm paying, all other features the same. Now, what if we're not assuming we're going to die in 20 years? What if we wanted to evaluate a different way? That's the NSCI. In this case, again, we're taking the future value of what was paid, we're reducing it by the future value of what was received, and we're also reducing it by the assumption that in 20 years, we cash it out and get the cash value of 110. That happens 20 years from now. That's already a future value number. Well, if that's the assumption that we're going to cash it out, the net amount of money we have laid out in future times is $109,167, so we're going to annuitize that number. We're going to take that future value at 4% over 20 years. That is the equivalent to having paid $3,525 a year. And on a per 1,000 of insurance, that's $705. Now, in this case, after 20 years, we cash out the policy, it stops, and you're never going to collect the face value. You have surrendered the policy, accepted the cash value, that's the end of the transaction. So, complicated assumptions. If we had multiple policies, it would be interesting to look at it, but then the key issue is, are these realistic assumptions to what's going to happen to you? And are all the policies you're comparing, are these the only differences, or are there other features that differ among the policies? It's a starting point of analysis, but certainly as far as you would go.